Good morning. Welcome to the morning market briefing. It is November 16th. It is a Wednesday, and Andrew and Ben are out. We've got Harrison Pettigrew, one of our new guys filling in, going through the news this morning.
Oh, yeah.
Hope everybody's doing all right. Kicking it off, the big news really yesterday afternoon was a Russian-made missile landed in Poland. There's been a lot of chatter as to whether it was one missile, two missile. It either hit a silo or a grain elevator. It killed some civilians. And for probably about an hour yesterday afternoon, we saw the markets dip quite a bit on the news with the assumption that we were hitting World War III, enacting NATO's Article 4 to protect the entangling alliances on the occasion that they were being attacked. But it came out last night. It seems like there's not a lot going on there. Obviously Russia blamed Ukraine. Biden came out and said it's unlikely the missile was fired from Russia. It doesn't seem to be amounting to much, but there could be potential market implications should the NATO alliance, basically meet and move forward and decide whether or not they're going to make a decision on this. Harrison, what do you think the ultimate outcome is on something like this? Do you think it's anything? Should we keep track of it, or is it just a one-day kind of?
I think it's a one-day kind of thing. I mean, the G20 came out and they said they have a declaration against war. I think NATO doesn't want to get involved in something like this. I mean, we did have 2 civilians die, which is obviously unfortunate, but I don't think NATO wants to get involved over something that is slightly minor in the scheme of things.
My read on it, and I don't know where the missile came from, obviously, but my read on it was almost like even if it was Russia and their plan was to incite some sort of rise, the move by NATO just to be like, it's nothing, is actually kind of a smart move. It's almost like the international version of ignoring the bully, which is if they can't get a rise out of you, nothing really happens. So that's kind of my assumption is what happened. They basically put their heads together and said, we're just going to ignore this and, eliminate any further escalation. So for the time being, it's on the back burner, but definitely something to keep an eye on, particularly as we're seeing the development of the Russia, China, India alliance. They've been buying Russian oil. They've been helping each other out. It looks like those 3, massive countries have been forming an alliance against NATO, sort of an East versus West development. So something to keep an eye on, but it hurt the markets for about, I don't know, call it an hour and a half yesterday afternoon. But we came right back up. In terms of economic data this morning, we've got CPI coming out of the United Kingdom. And unlike what we've seen here in the last couple of weeks with the data points coming out, we saw inflation accelerate in the United Kingdom. Earlier this year, the Bank of England was very clear that they thought that inflation was going to hit 15%, and we're definitely on the march upward. The core came in line really with estimates. So what do we take away from that, Harrison, in terms of, we're seeing some progress on our side of the pond. The UK is obviously ticking up. Is there any key takeaways from a market perspective, or, you think it's just a divergence of policies?
I think it's definitely a divergence of policies. I mean, it shows that what we're doing here may or may not be working. I think, one data point's not a trend, but we're trending in the right direction. The euro area, however, is concerning. I mean, the UK, obviously, we see the data out, it's accelerating. The vice president of the ECB came out. I think they had the financial stability review, and they seem very, very scared right now. They actually see a potential liquidity crunch as well. I think Luis de Guindos said he wants banks to start taking more provisions for bad loan losses. He says, the combination of inflation, rising fund costs, and lower liquidity could trigger potential financial turmoil in the region. I mean, that's obviously not the UK, but I mean, the ECB in the UK, right? I do see some trouble there.
Yeah, they used to be 1 and now they're 2, but all of those loans, most of them were issued before Brexit.
Right.
They have the same provisions and they could be entangling, particularly on the economic front. So yeah, something to keep an eye on tomorrow. We've actually got the Eurozone CPI, so we can see, how in line that is with the UK, see what the divergence is in terms of their number as well. I expect that to come in hot. Their numbers have typically been lower on average than the US, but upticking. But, you've got pockets like the Netherlands and things like that, Poland, where we've got high double-digit inflation. So that'll be an interesting read through. One data point that just came out at 8:30, which may be, a bit of a negative read in terms of, what the Fed action is going to be, is we actually had the retail sales number come in, which I think is a pretty good indicator of what people are doing in terms of buying and selling. So the expectation was for a 1% increase. And last month we had a 0% increase. So, the idea was the consumer was slowing, demand was slowing, we're buying less goods.
Right.
But that number came in hot at 1.3%, and ex auto, ex gas came in at 0.9%. So, you basically got all of that, the lion's share in true retail sales, not buying cars, not purchasing things at the gas station. You're literally buying goods at places like Walmart and Target. We saw Walmart absolutely crush expectations yesterday. We've got Target on the docket to talk about this afternoon or later in the call, which should be interesting to discuss. You can definitely talk about divergence, and we'll get into that later in the call. But retail sales picking up means more demand, which likely means that we might have a little bit of an acceleration as it relates to inflation going forward. And just to quickly take a look at the bond market, see what the reaction is there. Yeah, we're already seeing a bit of a sell-off on the retail sales number, which is probably to be expected because this is a good piece of economic information, which means that it's a bad piece for potential rate hikes. Which kind of leads us into our next piece. Esther George, who's the Kansas City Fed chief, gave an interview to the Wall Street Journal, and she basically said, we're not going to be able to get inflation down without a recession. It may not be possible. Notably, she's retiring in January, so her say in terms of what they're doing on the Fed ends here in the next, call it 45 days. But kind of an interesting take, one we've kind of been on for a while. Harrison, what do you think? Do you think we can actually get the inflation down without crashing the economy, or do you think that the Fed is again signaling that, hey, we're just going to keep raising rates until we break something, and that's going to be our solution?
I think the possibility of a soft landing is lowering dramatically. The most recent CPI print maybe indicated that it's possible, but I think those chances have kind of gone out the window, in my personal opinion. So
yeah, I think that's basically what she's saying here is that, we're not gonna land this thing softly. It's gonna have to land hard, otherwise. Basically her comments were, when you think about inflation data, we've kind of turned the tide on the supply chain, production side shortages. What we're really looking at now is labor being the driver here, which we've talked about a lot, which is that as prices continue to rise and stay elevated, wage inflation's got to kick in. Otherwise, people are going to be falling behind. And that becomes a pretty endless cycle. So the best way to do that is to have widespread unemployment, people losing jobs and having to come back and take lower wages rather than higher wages. And so I think that's basically what she's signaling there, which I would argue leads to the to further rate increases going forward.
And I think you'll see more and more Fed officials come out and start saying that. Just to try and guide the market slowly towards there.
We've been so hot.
So
we'll jump into earnings first, and we'll finish up with the Trumpster. I know everybody wants to hear about his speech last night, but we did, along the lines of the retail sales, we had some earnings reports come out. I'm gonna throw it to Harrison to kind of go through the numbers here, but the first company that reported was Lowe's, which could be good for read for Home Depot, which is a large holding we have, and it looks like they actually had a pretty good quarter.
They did. Yeah, so Lowe's, big acceleration for Pro, as well as improved trends in soft it yourself business. I think it was like 75% of the business, and higher sales and good cost control, which result in higher margins than the guidance. So it's on guidance, the operating margin is about 13%, which is slightly up to trending higher from 12.8 to 13%. Earnings up. Margins appear to be holding, pretty steady. And I think that's because do it yourself has been, slightly a headwind, but pros are doing fine. Home Depot said that their consumer is slightly different from the average American. I don't know if it's the same for Lowe's, but if you look at the people that shop at Home Depot and Lowe's, for instance, it's homeowners, and those people just tend to be doing better right now. If you're a renter, things are a little tough. But that side of people, they're doing okay.
Yeah, and I think that lends itself kind of what we saw with Walmart, which is that the level of wealth that's moving into the lower end of the retail area is interesting. The number of people making over $100,000 a year that's shopping at Walmart is an all-time high, which I think leads us into our next conversation, which is that demand has to come from somewhere, and it appears that Target is where we've seen those people migrate from. Target reported earnings this morning.
Pre-market, they're down 14%.
Pre-market, they're down 14%. They had really weak margin results, soft comps year over year.
They lowered guidance for the third time this year.
Yeah, they lowered guidance for the third time. If you guys recall, earlier in the summer, they had a tough quarter in Q2, and then a couple weeks later, they came out and said, "Hey, not only was that bad, but it's going to get worse." They've said a lot over the last couple months that they're improving, they're getting rid of inventory, they over-ordered on patio furniture. But the real story, I think, and Sam is actually on the earnings call listening right now, and he's kind of chiming in with the notes via chat here, is that the mix has changed. And we've talked about that a little bit in the summer, which is that people are going to Target, but they're not buying those big items. What they're buying is the stuff that's on sale. They're buying the stuff that is low margin. And as a result, it's like they're seeing, the same level of buying, but the problem is they're making less money per transaction. And, whereas Walmart's the opposite, they're seeing people who are a little bit wealthier going to Walmart and buying some of those bigger ticket items. But the difference is with Walmart, the overall price is lower, so they're basically, instead of buying the high ticket items at Target, they're going elsewhere and buying them at Walmart. And I think that's really the trend you're seeing. They're basically saying that they saw that start to really accelerate in October. And then the first couple weeks of November, the same thing. People are buying cheap goods. They're buying low margin goods. They're buying the stuff that's on sale, and they're not really buying much else. And so Target's taking it on the chin this morning. It's one we've definitely been moving out of over the course of the year. It's been one we've held for many, many years and has done very, very well. And in fact, during the COVID era, they were really positioned, excellently. There was no better operator during COVID than Target. They absolutely crushed. But over the last, call it 6 months or so, they've been walking a lot of that back, and their management team seems to be just absolutely lost in this environment. So it's going to be a tough day for Target. We obviously have a much smaller allocation than we used to. I think when I first came on at Narwhal, we were upwards of 4% per client. It's probably closer to 1% now. But it is still one we have exposure to, and they're having a bit of a pullback today. But the final piece, and Harrison, I'll let you jump in on this. As a young voter, we've seen Donald Trump jump back in for the president. I'm assuming you're old enough to vote for the first time for 2016. Could you vote in 2016 when you ran the first time? Okay, yeah. So he's back again, ready to rock. Basically saying, pandemic's over. Trump's getting back in. He claimed a lot of victories for, the wins that he got at his endorsed candidates, ignore the ones that he lost. Pretty standard stuff. But what do we think? Does this have an impact on markets? Do you think it's too early?
Too early, definitely right now. However, I think as the campaign picks up speed, then you'll start to see some things. I think it's too early to tell just because the House hasn't gained majority yet. We call it the red sprinkle, right? But if the House does get majority, and maybe Trump coming in might do something there. I doubt it. But yeah, nothing right now. Too early to tell.
Yeah, I think there's a lot of I think over the last couple of years, people have really, with him dropping off Twitter, with being less visible, I think his the fervor with which people were on board with Trump has waned quite a bit, even with some of his most excited fan base. And I think there's been a number of candidates that jumped out. I think that obviously DeSantis is the front runner right now. Glenn Youngkin out of Virginia, I think, is probably second behind that. So I think it's early. I think if you look back to some of the previous elections, the person who ultimately ends up being the candidate kind of comes from behind and never really is obvious from the beginning. If you recall correctly, Biden was not the front runner heading into the first few caucuses there. We had everybody basically drop out and get behind him late in the game in order to consolidate into one candidate. Trump obviously started, I think there were like 24 initial candidates in 2016. And he seemed like a long shot the entire time, and then ultimately ended up winning. So I don't think it's much. I don't think there's anything to read through on the markets, but it is something to take note of.
What will be interesting though is to see, who on the House and within the GOP starts to migrate over back towards Trump, because we saw some people fall out, but who's going to hop on the bandwagon again? I think that'll be the most telling sign.
Yeah, I think additionally, when it comes to passing new legislation, if you see something that Trump is heavily on that ultimately might go the other way because people are actively voting against him, kind of as a show of power for the traditional Republican Party, it could be have an impact on the market. But something to keep an eye on. And then lastly, in politics, the Senate voted to end the COVID emergency declaration 62-36. It's notable because Biden said he would veto it. He's been trying to extend a lot of these emergency provisions towards March, including the student loan forgiveness program that got struck down last week. He's trying to push these things forward. I mean, what it does is essentially gives a ton of money for federal spending. He can kind of direct it as he wants to. And if we end the pandemic, it definitely limits his executive powers, and it limits the amount of money he can play with in terms of getting things done that he'd like to see done. It's notable that in September on 60 Minutes, Biden said the pandemic is over, but in terms of the reins of the government, the power, the amount of money that can be thrown around, we suddenly don't want it to be over, but it has been officially voted over. So we'll see. We'll see if it ultimately gets vetoed, if we're continue to be in a state of emergency for the third straight year. So I think that's all we've got, unless Harrison, you got anything to jump into. We've got TJ Maxx in the morning. We've got Cisco and NVIDIA tonight. Any thoughts on those coming out?
Nothing yet. I do want to mention one thing. This kind of ties back into kind of just the consumer and economic situation. Home equity loan line of credits are up 40% year over year, making it the highest they've been in 3 years. I think the average rate for a home equity loan line of credit right now, we'll call the HELOC, is 7.7%, whereas a credit card APR is about 19.4%. And so what we're seeing right now is, the average homeowner is now using home equity loan line of credits as a credit card substitute. So I think they do see there being potential headwinds going forward.
Yeah, the credit situation as things tick up, as the Fed gets more aggressive, assuming that they do, there's a lot of these things that are floating, which could be the first things to go. And, HELOCs are definitely that. I mean, I think we peaked out at 9.6% on the average one earlier this year as rates popped. And, we've seen that come back down a little bit over the last couple of weeks. But, people are trying to shuffle around that debt.
Right.
If you got credit card debt, it's at 20%. It seems like a great idea to go ahead and take the equity out of your house and pay that down. The problem is if the Fed keeps raising rates, you can very easily get right back up to that level very quickly. And the difference is if you don't pay that, you can lose your house.
Right.
Whereas if you don't pay your credit cards, your credit looks pretty terrible, but at the end of the day, you probably won't lose your house. So something to keep an eye on. I mean, we talked a little bit about that with the loans in the United Kingdom all being floating and how that could potentially cause a financial blow up. We don't have a lot of that, but we do have that with home equity lines of credit. They are floating for the most part. And so that's something to keep an eye on as that number starts to tick up. So just one more potential blow up, but hopefully people are being responsible. And the good news is a lot of people have a lot of equity in their homes, and the average interest rate outside of that is pretty low. So if you blend the two, hopefully it's affordable. But as always, there are three ways to they say the three L's that can destroy men. It's liquors, ladies, and leverage. So everybody be careful with your leverage. Don't get too much debt or you'll end up financially unhappy. So we'll leave it at that. Everybody have a great day, and we'll be back here tomorrow.
All right.